Hey everyone, welcome back. Today I'm thrilled to launch something. It's a little bit different on this channel. We're going to be doing a small portfolio challenge. The idea is to show that you don't need a big chunk of money or fancy financial wizardry to starting investing. All it takes is a little bit of cash and a lot of consistency over time. We'll use real numbers, real strategies, and real trades so that you can see exactly how this unfolds and hopefully feel inspired to start investing of your own. I'll be doing monthly updates or as needed updates over time. Just kind of depends how things go. And the plan is to keep this going. Our goal is to grow this account from $200 to $100,000. So why a small portfolio challenge? Well, the motivation behind this challenge comes from the many people that I've talked to who want to start investing, but they feel overwhelmed. They worry they don't have enough money or enough knowledge or enough time. They see big headlines about YouTubers or day traders making huge trades, and it gives them this sense, it makes them feel like they're already behind. But let me tell you something right off the bat, you're not behind. Everyone's journey starts somewhere, and for most people, including me, it starts small. I started trading whenever I was just 15 using an account that my grandmother let me open, chasing pump and dumps, which I don't recommend, by the way. Don't do that, especially if you're new to this game. But at the time, I knew that this guy, he would essentially just pump these stocks several 100%. So I would just hop out early with a 30% gain. But that's a story for another time. We can get into that later. The point is that almost everybody starts out somewhere, and usually they start out small. So there's a concept from Ray Dalio about setting goals and continually working towards them. And even if you slip up, we start by setting a goal, we fail, we figure out why we failed, and we improve so that we can keep setting more audacious goals. It's a cycle that we go through. It's normal to lose motivation, get sidetracked, or face setbacks. And maybe you intend to save $100 a month, but your car suddenly needs repairs, or you miss a contribution, and it's fine. That's life. The key is to recognize you fell off the path, simply get back on. If it happens again, no big deal. Just keep returning to that goal over time. You only fail when you give up on your goal entirely. And remember this, 90% of success is just showing up. Even if you can only save $1 a month, do it. You might think, well, $1 isn't going to fund my retirement, and you'd be correct, but you're not just saving $1 for the sake of saving a single dollar. You're saving $1 to build a habit and a mindset of paying yourself first over time. Those habits can scale up. If you keep skipping out entirely, you'll look back when you're 50 years old and wish you had started earlier. It's not about the amount that you start with. It's about making sure that you start at all. So how are we going to get started? For this small portfolio challenge, I'm going to open an account with just $200. Every month, I'll add between $200 and $500 depending on the market situation. And so why those numbers specifically? It's because I want to demonstrate that even on a modest budget, investing is possible. It's one thing to see someone start a portfolio with, say, $100,000. It's exciting, it gets a lot of views, but it may not feel realistic to your average just working full-time job type of person. And in reality, most people's first investment experience often comes through their employer. Their retirement plans like a 401k, perhaps setting aside $50 or $100 a month in a brokerage account. So this challenge is meant to replicate a smaller, more typical scenario. By doing so, I hope you'll see how each small step, consistent contributions, can add up to something meaningful over time. So our first goal here is going to be to get the account to $1,000. And I like setting more short-term goals because I find it gives something that people can look forward to, as opposed to a lofty goal way off in the distance, like say $100,000 down the road. It just seems almost unobtainable. So by setting smaller intermediate goals, it helps you stay motivated. Like, oh, I hit my first goal. I'm at $1,000. Great. Now we can move on to the next one. Let's get to 2,000 and so on from there. Now let's talk about modern portfolio theory real quick and why I'm partially disagreeing with it for this particular challenge. So essentially, it says that you should diversify broadly to minimize your risk and capture market returns at the same time. That usually means mixing, stocks, bonds, real estate, maybe some gold. I happen to prefer utilities to gold because it offers slightly better return in a carefully weighted basket so that if one of these assets were to dip, another one might rise at the same time, or at least hold steady, keeping your overall portfolio on a smoother ride. But here's the thing. That theory is fantastic if you're trying to protect large amounts of money and you can't afford big drawdowns. Like if you're a retiree or a big institution, a 20% drop might be catastrophic if you're depending on that money right now, especially if you're older and using the 4% rule for income and retirement. However, for a small account, especially in the early stages, your primary focus is growth. If your account is only $200, a 20% drop is only $40. Yes, losing $40 isn't fun, but it's also not the end of the world. Meanwhile, if you take a bit more risk and get a higher growth rate, those early gains can compound exponentially over time and really give your account a boost. Now, I'm not saying to throw all your money into the riskiest penny stocks that you can find. Please don't do that. What I am saying is that for smaller portfolios, the cost of being overly cautious is often missing out on the chance for stronger returns whenever you're younger, either being young in age or young in your investing journey. And you can handle some volatility as your portfolio grows larger, or as you near financial goals like retirement. You can rebalance into a more diversified, lower volatility mix of assets. So one caveat I want to stress: even if you're going heavier into the growth-oriented assets, try to stick with high-growth blue chips. When I say blue chips, I'm talking about established, well-known companies or major tech ETFs that still have a proven track record. In the crypto world, that's essentially going to be your Bitcoins and Ethereums, as opposed to just random memes coins like Fartcoin, for example, on Solana, which could vanish tomorrow. And in the world of stocks, it's major technology companies or consumer goods companies with strong fundamentals. For example, I see Tesla being a blue chip that will outperform long into the future because of their Optimus robot. If you want to see my video on that, check that one out. But when you're dealing with $200, $300, or even $1,000, you're not going into retirement off that tomorrow. The point is to learn, gain confidence, and ideally ride some of the growth waves. If you're able to get a 10x return on $300, that's $3,000, which is still not a fortune, but it's that momentum on the early stages that can really give you confidence and can motivate you to keep going and save more over time. Consistent contributions plus occasional big gains like this can really start to add up for an early investing career. Now, if this was a larger account, let's say 100,000 or 500,000, my strategy would look different. I'd lean heavily into something like a NASDAQ ETF because historically it's averaged a solid return, often between 15 and 18%, depending on the exact time period that you're looking at. In addition, I might sprinkle in some positions other than the ETFs that I think will outperform and boost the portfolio's returns, like Ethereum, because I personally believe it has the potential to continue to outperform the NASDAQ over the next decade or maybe even 2 decades. And why I believe that is because Ethereum is more than just a cryptocurrency. It's an entire decentralized computing platform used by corporations, developers, and even some governments for various projects. So an important example that I want to highlight is if 99% of your portfolio is in the NASDAQ and just 1% in a high growth asset that somehow does 100x return, you've essentially doubled your entire portfolio because that 1% times 100 ends up being 100% of your portfolio value. So if you have a $100 portfolio, now it's gone to 200. Sure, that's an extreme example, but it illustrates how a small slice of a high growth and possibly higher risk asset can significantly boost your returns. Again, I want to emphasize that I'm talking about a very small slice of the portfolio, especially for a larger account. But when the total account is small, your slice might feel bigger in percentage terms. So true diversification versus our reality. According to the theory, true diversification would mean that you have 15 to 20 uncorrelated assets. That essentially means that if one asset goes down, the other ones are likely staying the same or increasing. And that might involve mixing different asset classes like stocks, bonds, real estates, commodities, different global markets, whether that's domestic or international and so on. We can't realistically do that with a $200 or $300 portfolio. The transaction fees alone, unless you're with a a fee-free broker, and the complexities of rebalancing just make it impractical at this stage. As the account grows, I'll absolutely start introducing more diversity within the portfolio, especially in ETFs. Personally, I like to keep a big chunk of index funds like the NASDAQ, like the S&P 500, because they offer a broad exposure to major companies. Over the long term, these indexes have shown very reliable growth. From there, you can allocate smaller positions to things like Ethereum, high growth opportunities. Eventually, we might consider smaller allocations, no more than 5% to any individual asset. That could mean certain tech stocks, maybe other cryptos or other sectors that might look promising in the future. And if the market tanks, by 30 or 40% and you're worried, remember, you only lock in losses if you actually sell. If you're planning to hold for the long term, you can keep adding money during these periods. Historically, most large-scale market declines have eventually recovered. And of course, no one has a crystal ball, but the track record for the broad market is in your favor over the long run. So let's move on to the exciting part. What am I actually buying today? I'm going to start by purchasing BlackRock's Ethereum ETF, ticker symbol ETHA, an Ethereum ETF from one of the world's largest asset managers. This is a pretty big deal in my opinion because it means that mainstream finance is formally recognizing Ethereum as a legitimate asset, much like they did and still do with Bitcoin. But why Ethereum? So governments are beginning to accept digital assets like Bitcoin, but Ethereum is uniquely positioned. It's more than just a store of value. It's an entire ecosystem that powers a decentralized applications, smart contracts, and the tokenization of real-world assets. At JP Morgan, Sony, Samsung, huge names are experimenting with building on this ecosystem, this platform, whether it's for payment solutions, identity verification, digital asset issuance, or supply chain tracking. Ethereum is emerging as a kind of digital global infrastructure. So for that reason, I find a lot of value in it. And we're still really early in this adoption curve. If you zoom out and imagine a future where most global finance, gaming, and even social media interactions are underpinned by a blockchain, Ethereum, Ethereum is often the go-to platform. Now, that doesn't guarantee that it'll stay on top. Technology moves, and it moves fast. There are competitors, but for now, Ethereum has a massive developer community and a strong network effect. This brand new ETF, ETHA, it gives me regulated accessibility in a way that I don't have to expose myself to having to hold on a crypto wallet. Now, I do have crypto holdings other than what's in the public portfolio here that's outside of the brokerage, but it's a big point because it allows for a lot of people with 401ks, retirement accounts. They can now simply go in and just add that to their existing retirement portfolio. Okay, so let's go ahead and take a look at the chart here. So you'll notice if you paid attention to my last Ethereum video where I talked about, essentially I thought the price was going to come down here. We saw it tag the red line here. That's the 50% retracement. And then we saw this candle here. You see this wick. So it came down, that algorithm kicked in, started buying it up. And then these algorithms, they play from both sides. So essentially what I did here was I pulled from the high coming down to the low at the 50% retracement. And then you saw it came right up into the golden zone. Algorithms have kicked in. They started buying it down. They just tagged their target at the 2900 level, and you're seeing that reaction. We're also seeing confluence where I have this blue line noting that it bounced, multiple times in the past. You look over at the right-hand side of the chart, you have a what's called a low volume node. What this is showing you is it's showing you volume by price as opposed to what you're probably used to seeing, which is on the bottom, and it shows you volume by time. So this is showing that below the 2900 price target, there's not very much price acceptance at all. So if it drops below there and it breaks down, I really don't want to see that because you have this low volume node. So it's pretty much just going to move very quickly down to the 2700 level. This is really strong support. I would be surprised if it does move down. The other thing to note is that this appears to be a head and shoulders pattern. I'm not a pattern trader. That's not what I trade. I know what they are, but I don't trade them. But you'll notice you got a little shoulder, you've got a head, and then you get another shoulder, and now it's breaking down. That's not how I trade, and especially for this small portfolio challenge, we're just going to go ahead and buy here, because to me it doesn't matter the price whenever I'm buying into a large portfolio like this, and especially it's only a $200 starting position, so it's not the end of the world. So if this was a larger position, I would stack in my position as I should with laddered buy orders, but we're just going to go in here. The ticker symbol is ETHA, and we've got a quantity of 8 that we're going to be buying. So we're going to go ahead and just review that order, place order received. All right. And so that's the start of our small portfolio challenge. Now I want to talk about the power of consistency. So one of my biggest messages in this entire challenge is consistency. If you contribute $200 a month, you might not see fireworks right away, or maybe even in a year, but you'll put in $2,400 plus any gains or losses at the end of that year, and that can really amount to something over time. Some months you might be a little bit rough if we go through a recession. Maybe you'll be down 10 or 20%. Other months you might be stellar. You might be up 30, 40%. It just depends. The point is to keep going and adjust your strategy responsibly and as your knowledge and your account grow. So there's a phenomenon called dollar cost averaging, and this can really help you. You invest consistently at irregular intervals like we're going to be doing every month, regardless of price. Sometimes you buy high, sometimes you buy low, but over time it averages out. This removes the pressure to guess the perfect market timing, and a lot of people find it mentally liberating because you're not consistently waiting for a market crash to scoop up the market or worrying about a missed bottom. So kind of wrapping things up, that's basically the plan for our small portfolio challenge. Start with $200 and add $200 to $500 each month. Ignore the short-term noise and strategically pick assets that have solid growth potential. We'll keep an eye on the big stuff like Bitcoin and Ethereum, but we'll also look at more traditional investments like the NASDAQ, S&P 500 ETFs. And, as the account grows over time, at some point, if I see an opportunity or something interesting, maybe in tech stocks or a smaller altcoin, I might nibble there too, but carefully always balancing the potential upside with the risks involved. So today's first move was buying ETHA, the Ethereum ETF from BlackRock. This is me putting my money where my mouth is regarding Ethereum's long-term potential. I'm excited to bring y'all updates along the way for this portfolio, maybe once a week or once a month. It just kind of depends. We'll have to see how things go. But we'll be tracking all this portfolio's progress together. We'll talk about what went right, what went wrong, and how we're adjusting to different market conditions as it evolves. Now, if you're on the fence about starting your own portfolio, I hope this helps you to see that you don't need to be a millionaire or even have thousands of dollars to begin. You just need the willingness to put some money aside, build a habit, and stay informed. The next step is getting comfortable with choosing your platform, whether it's a brokerage account, a 401k, crypto exchange, and then automating your monthly contributions as possible. Automation always makes things easier over time. Remember, the best time to start investing was yesterday, and the second best time to start is today. Don't let fear of the unknown keep you from securing your financial future. Even small efforts now can really grow into being something amazing over, a period of time. So that's all for this update. In the future videos, we'll check in on the portfolio, see how it's doing. Be sure to like and subscribe if you're interested in this journey. And if you got any questions, drop them in the comment section down below. And until next time, y'all take care.